Hey guys, on today's episode of Buy or Pass, we're going to take a look at the financial documents of United Airlines. So let's begin. Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment. Would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. Let's begin. This is going to be part 2 of our 2-part episode. Part 1 was posted a few days ago on United Airlines, where we took a look at their investors letter and their earnings transcript. Today we're going to take a look at their financial documents. So if you want to know a little bit more in detail outside of the numbers of the company, definitely go check out that previous episode so you guys are more informed on the company. But right now, like always, we're going to use the website known as Lazy FA, which allows me to look at all these numbers in an easy visual format, which makes these episodes go pretty fast. So since they just reported Q1 2019, we're going to take a look at quarterly data opposed to annual data. So right now, we can see revenue so far has been up. Revenue has its little jumps up and down if we look line. But right now it does have its uptrend going up. We can see quarterly data. Q1 seems to be the lowest. Q1 and Q4 seem to be the lowest of the 4 quarters per year. So we can see though this quarter 2019 is still higher than quarter of 2000, and we saw that in the numbers that we posted on yesterday's episode. Cost of revenue, though, is pretty good that we seem to see the cost of revenue. It's not a steep incline compared to our revenue incline. We can see here gross profit, even though Q1 gross profit is lower compared to the rest of the year. This year's pretty strong gross profit, sitting at $5.8 billion compared to last year's same quarter was $5.3 billion. Earnings before income tax, I see nothing outrageous going on here. If I saw something weird, I would take a look at where their expenses for cost of revenue is actually going. But since there's no abnormality here, we can skip that. And same with net income, right? We can see it's pretty stable to how it normally is. And again, take a further look in there. But we can see our net income this quarter was $292 million compared to the same quarter last year was 105. That's definitely a big jump in net income quarter to quarter, almost 100% increase on net income. So to me though, that is pretty low, right? The amount of money this company is keeping after all the revenues, collecting revenue billions per quarter, collecting somewhere between not even half a billion dollars worth of net income. Next, we're going to take a look again at their income statement, but we're going to take a look at different graphs, kind of showing us the same thing, revenue versus cost. Here we can see that gap between revenue and cost increasing every year. Early in 2012, that gap was a little bit closer, which would give us these gross profit, but we can see gross profit is increasing quarter after quarter. That has this healthy uptrend that we can see happening here, and that's just because we're collecting more revenue and paying less cost of revenue. Next, we're going to take a look at revenue versus cost of revenue growth, and we can see here everything seems 1-to-1 ratio. So there's nothing here that's really getting my eye or catching my attention. Next, we'll take a look at gross margins versus profit margins. This company definitely has a strong gross margin, 60.5%. But what I did not know I'll take a look at different airlines, but their profit margins are pretty low. Per quarter, we're talking about a 3% profit margin. Last quarter was, I would say, 1.6. So yeah, they almost doubled their net income compared to last quarter. Just for my sakes, I want to take a look at annual data, last year's profit margin. And I don't know why I feel like that's such a low number of the amount of money they're collecting based on. Next, Lazy FA is giving us some flags. The first flag is telling us dilute excessive dilution alert. So this is, we can take a look here. This is a flag that's going off from 2010, where they increased the amount of average shares ever since 2016. This company has been buying back its shares, and there has been a decrease in the amount of float per share. Take a look quarter to quarter. Even this quarter, they did mention that they were buying some shares, purchased over $527 million of shares in the first quarter, and they have $2.1 billion left to go. We can see here that they are decreasing the amount of float shares out there. That flag wasn't really anything for me. The next flag we have is just telling us that the growth of net income, right? It's just telling us that this is a crazy growth of net income in 2012. But again, this could be a bug, and it's not an issue that I need to keep an eye on, since it was a bug and it's something that has to do with 12. Next, we'll take a look at the balance sheet. In the balance sheet here, we have total assets, liabilities, debt, receivables, payables, and cash equivalents. Quarter by quarter, we can see again these total assets are increasing at a small rate. This quarter had a $50.64 billion of total assets compared to last quarter 49. Definitely a nice 5%, I would say, not even that. About a 2% increase in total assets. Unfortunately, we can see here total debt was pretty flat for some time. Past 2 quarters, it jumped from $14 billion to $8 billion, so an increase of $6 billion in total debt. That's definitely a number, and we can see your total liability is taking the front of that. Our total liability from $35 billion to now $40.84 billion. This company does seem to have a healthy amount of cash and cash equivalents, even though the amount is decreasing over time, still sitting at about $4.17 billion of cash and cash equivalents, which is definitely a healthy sign. This company has some money on the side for things. Next, we're going to take a look again at the red flags balance sheet. We're just going to take a look at what we saw in a different format. Here, my favorite thing that I'm definitely taking a look at, I like, is assets versus liabilities. That gap between total assets and total liabilities are increasing, which is giving us a higher shareholder equity every quarter. So we can see right there was this healthy jump, and now with the expected revenue growth to continue, the shareholder equity is definitely going to get stronger. Next, we'll take a look at assets versus liability growth. Again, everything seems to be almost a 1-to-1 ratio. There's nothing here that catches my eye. This is, if you've been watching the show for some time, these are my favorite things to take a look at: asset distributions and liability distribution. Here in assets distribution, that 67% of the assets are based on property, plant, equipment. This to me obviously makes sense. This is an airline company, so most of their equipment and products are airplanes, facilities to operate the airplanes, and take care of to park the airplanes. So for this to be such a huge value, normally it would kind of throw me at the side, but for now, this is definitely good to see. That means they have plenty of planes and of real estate to take care of the plane. Next biggest thing we have here are cash and cash equivalents are about 8%, and intangibles are about 15.38%. I definitely think that's a high rate for intangibles. Not too. Next, we have liability distribution. If we take a look quarter to quarter, this is pretty scary that it's non-current debt. It's about $8.1 billion, and it's a total of 6.83% of the liability. The next big thing seems deferred revenue. Deferred revenue is not bad. This deferred revenue will eventually become assets or some form. This deferred revenue will become revenues later on. So for them to have that big of deferred revenue, that their credit cards that are being paid, since they do have a credit card, this is probably the credit they are due. That's actually, in my mind, deferred revenue. I like to see it as future assets. Next, we have current debt. Current debt is about 7% of the company's liability. Actually, sitting pretty high, not that high, at $2 billion. Here, we're getting two. How many red flags are we getting? We're getting two red flags on Lazy FA. The first is current ratio deterioration. So this is the current ratio. So current ratio is the ratio between total current assets and current debt. So if we have more assets, current assets than current debt, then we would have a ratio over 1.0. If we have higher current debt than current assets, we will have lower. So right now it keeps decreasing. It's definitely a scary thing. This company there took too much loan for a certain amount of period of time, where right now those total current liabilities and debt are time to pay off, and it's time. Next, outliers in cash growth. This is just annual. Right here, if we look in 2010, there was a huge increase in cash and cash equivalents. It's just telling me, hey, take a look at these numbers. Final thing I'm going to take a look at is net cash flow from operation. Favorite things to look at, if the company is making money from its everyday use. Here it has a positive $1.92 billion of cash flow from operation compared to the same time last year, which was at $1.6 billion. So right now, some things I do like about the numbers we just looked. The net cash flow from operations is definitely a good thing to me. The increase in property, plants, and equipment and asset distribution is pretty good. It means it has more plane passengers, needs more revenue. One thing I don't like is the amount of non-current debt this company has, and even though the asset shareholder equity is high, that difference between assets and liabilities is such a close ratio that I'm not that comfortable with. Finally, if we take a look at the income statement, this company is producing higher revenues over time, gross profit over time, but the total net income for these companies, profit margins are pretty low, right? I'm talking about 3% profit margin for the company. I think for something this big, that is such a low number. Then taking a look at the previous information we saw in last episode, favorite things were company is increasing this earnings per share, and I think for that reason, at the moment, I would give United Airlines a soft buy. Like, I would not go full in how I normally go with my normal investments. I would go with a light position because it is a growth company. They are increasing profit margins, which lead to more net income. But again, this does seem to be a slow growth company. For that reason, it's not a company I would go in fully. Alright guys, so that's the episode. Make sure to post in the comments what you guys feel about United Airlines. The company as a whole does not seem bad. It's definitely not a company that's gonna fail anytime soon, right? The company definitely is increasing its revenue over time. But for me, it does not fully scream a full buy. So I want to know, what do you guys think about United Airlines? Don't forget to subscribe to get updates on new episodes and other videos as well. I have more episodes coming in this week, so make sure to stay tuned. Have a good night, guys, and see you next time.